What's up everybody? Welcome to the Stocks channel. My name is Cory, and today in the stock market we had a very volatile day with the tech sector getting absolutely routed, but overall there were a lot of advancing stocks today as we approached the critical resistance at the big bad bear. First up, let's take a look at the S&P500 SPY ETF. So let's crack open this chart and see what's going on in the stock market today. Alright, so today's SPY was down 0.75% and we did have a very volatile day of wild swings because we did get the big tech earnings last night with Microsoft and Google, and they did see a massive sell-off today, which is the main reason the indices could not advance further. If you look at the small caps and you look at the Dow Jones and you look at the other sectors like financials, industrials, energy, and healthcare, you can see there were a lot of advancing stocks today. So what this means going into the rest of the trading week is that we are very likely going to continue to see lots of volatility with the rest of the big tech earnings because we do have Amazon and Apple tomorrow after the bell. And as you can tell looking at the chart, we are at very critical resistance at the big bad bear at SPY 390. Intraday we were pushing towards battling the bear, but it was just way too soon for the bulls to push up to there, because as you can tell from the upper Bollinger Band, we were getting too far overextended outside the upper Bollinger Band. There's no way the bulls will want to go up to battle the big bad bear while being overbought and overextended. So it makes complete sense that there needs to be some type of cool down before the bulls go make a crack at that level. Whether SPY actually gets to 390 or not is to be determined, but it is very likely that SPY is going to test that critical resistance, and then we could see another rejection and possibly even another leg lower. Just a quick reminder of the market structure, it is possible that we are going to be due for one more leg lower once we do see some type of rejection, and the price action trigger for that is going to be the breakdown below the support trend line and losing the breakout, which is also our risk level of support at 378. So right now I would watch for a rejection from 390 and then start getting a lot more bearish if we see a high volume rejection, a breakdown below the support trend line and our risk level. Then we will very likely start down towards another leg lower in this bear market. Remember, I continue to tell you I think we are still in this bear market while SPY is below 390, and so far we still do have SPY below 390, and this is very likely just a counter trend rally, which is a relief rally within the larger downtrend of a bear market. Obviously the bulls have everything to prove because we are clearly in a bear market, and the bulls will need to go win that battle where the big bad bear is waiting at 390, and then we could instantly start getting a lot more bullish. You're getting very high volume days, and some of those high volume days are very bullish looking candles. So you really do need to have a very open mind because in the short term we are in an uptrend, and I always tell you, you need to let the trend and the price action do all the talking. So we will instantly get extremely bearish if we lose this critical support zone because we are in the bear market, which means we are looking for the possibility of another lower high before the next lower low. So there's a lot to consider going over the next few days, but it's really as simple as whether or not SPY is above or below 378 and above or below 390. That is the trading range that bounds your risk whether you're shorting this market or going long on this market. You need to manage risk as a bull below 378 and as a bear above 390. On the Nasdaq 100 triple Qs, we were down 2.21%, so you can see a lot of the pain in today's market was definitely from the tech sector, with Google and Microsoft going down nearly 9%. And as you can tell, the triple Qs are rejecting from a negatively sloping 50 EMA, and we are back down below the breakout level at 282, but we are still above the support trend line and the 20 simple moving average. So just like SPY, I gave you a trading range to pay attention to, and on the triple Qs, that's going to be about 272 to 274 for critical support, and then this resistance around 282 to 284 for the critical resistance. If the bulls push higher, you're still looking for strong resistance at 288, and we're still in the bear market below 293. So watch that near term support because it does look like we could be testing it as soon as tomorrow. And if we do start to break down below that support, you need to get ready for that next leg lower, which is very likely going to be at least a retest of the lows in the 250s. Remember, we are still in a bear market, so do not rule out the possibility that the bears are going to show up at these strong resistance levels, and I continue to tell you the bears are not going to roll over and die without a fight. On the Dow Jones, we were down 0.03%, but intraday we did hit our double bottom price target at 320, and we did start pushing towards the gap close above, but we did not fully close the gap around 323. even though the bulls were trying to intraday. The bears stepped in at this gap fill of resistance and drove price back down below the double bottom price target, and we are now in a situation where the bears might try to push back down towards the support zone at 312 and the gap fill at 311. You can stay bullish in the Dow Jones as long as we're above this support zone, but if we do break down, look for that 50 EMA right around 309 and that critical risk level, which is the breakout of the neckline at 303. 303 is a long ways away, so make sure you're managing a risk right here around 311 to 312. On a bull breakout above 320, look for that gap fill at 323 and a retest of the previous daily high just below 325. On the Russell 2000 IWM ETF, we were up 0.49%, and we did get the second day in a row closing above the double bottom breakout of the neckline, which is that support at 176. And you can see this is definitely a very bullish pattern that could take us all the way back up to fill the gap at 188. We had a double bottom breakout in the Dow Jones and we hit that price target, so you need to respect this is a very bullish pattern in the small caps. So you need to stay bullish in IWM as long as we're above that neckline breakout at 176, and we also do have support at the risk level at 178. So stay bullish as long as we're above the neckline, and if we break down below the neckline and lose the support trend line, then you can start getting a lot more bearish. You could see intraday we did pull back, but we were just getting way too far extended outside that upper Bollinger Band, so there's no surprise that we're seeing the small caps cooling down because they're just trying to go too far too fast, and they will need those Bollinger Bands to continue to expand to allow them to climb towards the price target. On the Arkk ETF, we are up 0.21% today, and we did get the second day in a row closing back over the 20 simple moving average, but we're still seeing selling pressure above the resistance trend line at 38 and just below a negatively sloping 50 EMA just below 40. Bulls need to break 38 and then back over 40 and the previous daily high at 41, and then they will start looking more bullish in the short term. Watch that downside support at 37, 36.5, and 35. On the VIX, we were down 4.21%, so we're seeing the VIX getting crushed back down below that level just below 28, and we are starting to see the VIX crushing low enough to start favoring a bull trend. Remember, the VIX is down big today because a lot of the selling was just focused in the tech sector, and the VIX represents the fear of the entire S&P 500. So yes, the VIX is still elevated, and we could see a bounce in the short term while the VIX is bouncing below the lower Bollinger Band. But do remember, while the VIX is below 30, it is starting to look like it's in a short-term downtrend. On Bitcoin, we finally have a breakout in the bullish direction on high volume buying, with Bitcoin breaking out of the trading range with that decisive break above 20,000, which does mean Bitcoin could start to get a bull trend back up to the next resistance just above 22,000. Stay bullish as long as it's above 20,000 because that is the neckline breakout, and this should easily take Bitcoin up to 22,000 if this high volume buying continues. On Amazon, we were down 4.1% today, with Amazon rejecting from the 50 EMA of resistance right around 121, and we're right back down to the 20 simple moving average at 115. The next support will be 113, and then below 113, look for a retest of the lows at 106. Upside resistance remains 121, and on a bull breakout, we will be looking for the gap fill at 126. Amazon does have earnings after the bell tomorrow. On Microsoft stock, we were down 7.72% today, and we did get that strong rejection after earnings from that resistance zone around 250, and we're right back down below all of the moving averages with the price target, and we did lose some critical support at 242 and 233. Keep in mind, Microsoft has been a great leading indicator of what's to come, so if we are getting rejected and starting down for another leg lower, we are very likely going to continue to see this pattern repeating in the other big tech names like Amazon and Apple, and then very likely in the indices. So yes, other stocks are going higher, but big tech is the top 10 companies that move the market, so this is definitely a warning sign that we could be continuing into the bear market for that next leg lower. If Microsoft can't break back over resistance at 233 and 238, look for the next leg lower at 225 and 222. On Nvidia, we were down 2.75%, and Nvidia is getting rejected around that resistance at 134, but we are still above a positively sloping 5 EMA, and we are still closing above the 20 simple moving average. Look for this trading range between 122 and about 135 until we get a breakout, and it does favor the bears to show up at resistance while we're in this downtrend. On Tesla stock, we were up 1% today, and Tesla did hit the resistance and that price target right around 229, and we did see sellers at that level, and we did still close below a negatively sloping 20 simple moving average. We could easily see a bearish rejection from this resistance and still come back down to retest the support right around 205, and possibly even that next leg lower at 186.5. Use this level at 230 to manage your risk if you're shorting Tesla, because above that level, we could run all the way back up to the 50 EMA right around 250 and possibly even close the gap above in the 260s. On Apple stock, we were down 1.96% today, and we did see Apple getting rejected from the outside of the upper Bollinger Band because we were just getting too far overextended, and we're right back down below the support at 150, but still above the support trend line and critical support level at 147. A bull breakout is going to require a break above 150 and then the previous daily high around 152. And the bear breakdown will be the break below support at 147 for a retest of the 20 simple moving average around 144. The financials were up 0.24% today, and we got another day closing above all the moving averages, and we're getting very close to the resistance trend line. The industrials were up 0.35% today, riding the upper Bollinger Band and still above all the moving averages, and getting the second day in a row closing above the resistance trend line. The healthcare sector gapped up today, closing up 1.11%, leaving the gap above as now a down gap to be filled around 130, and we are continuing to see the bull breakout above the resistance trend line. The energy sector was up 1.36% today, continuing to close near that upper resistance trend line, which is now right around $89, and you can stay bullish as long as we're above 84. So jumping back over to the S&P 500, don't forget what I said about leading indicators like Microsoft stock, because those big tech companies do help move the market, and they could be giving us a very early warning sign of what's to come. It's always best to wait for price action confirmation, so while we can always have a trading idea, we need to let the price action and the trend do all of the talking. And right now in the short term, we are still above a rising support trend line, which does favor the buyers. Watch that very critical resistance just above where the big bad bear is waiting, because we are very likely going to see that battle in the very near future. Also, don't forget I have Bank Trade Alerts, which is an algorithm-driven trade alert service that only trades the ETFs TQQQ and SQQQ and sends you all of your buy and sell alerts directly via email and text message. You can learn more about Bank or how to subscribe by clicking on the link in the description of this video. If you're looking to become a better price action trader, consider joining the Stocks Channel Trading Discord community, where you get access to all of my intraday updates and analysis. You can find out how to join the Stocks Channel Discord by clicking on the link below. So thank you for watching, everybody. I hope you're crushing this market. And as always, I will see you in the next episode.